Matt, as you look at things, it's easy to sort of have a default reaction to this and say this is all Amazon, but actually there was a leveraged buyout over a decade ago. Yeah. You could quite easily blame private equity.
Yeah, and a lot of people do. The debt, basically the company was never able to get out from underneath. Covering this company for a number of years, executives would often say after they left the company, we had big plans, we wanted to do some major investments in the company, revamp certain parts of the business, but the private equity owners, Bain Capital and KKR specifically, would just not allow for that kind of a robust investment. So maybe they're sort of trying to cover their own problems, but it looks like private equity can largely be blamed for this. It's not just an Amazon story, as some people are reporting.
So Amazon crushed them, and I guess the debt killed them. And Matt, it raises the question, how much of a problem is there beyond just Toys R Us in terms of the amount of high-yield debt on the books of some of these companies?
I mean, it's a huge problem. We wrote this big story last year basically pointing out that a lot of the high-yield debt on the balance sheets of retailers is coming due over the next 5 years. I mean, basically, it's exploding as far as maturities. And so far, they've been able to kick the can down the road, so to speak, because of the way the money system is right now. And it's a big problem. So Toys R Us was the sort of first major shoe to drop. We expect more of these companies to face this situation going forward. Claire's boutique, a mall-based chain, is apparently going to file for bankruptcy soon. We reported last week. Sears seems to be on the precipice. So this is a big problem, and there's a larger sort of risk for the economy. These are a lot of people employed here, are sort of middle class and lower income workers. So it could have a broader effect on the macro economy.